turn back to the major indexes. Joining me now is Michael Jones, Chair and CEO at Caravel Concepts, which offers asset allocation, financial planning software to investment and wealth management firms. Thanks so much for joining. A rough day for stocks. Do you think it's overblown?
Actually, the reason is that Fed Chairman Powell cleared up any ambiguity today about where the Fed's head is at. The Fed is single-mindedly focused on tightening until they bring down backward-looking measures of inflation like CPI and the GDP deflator. They don't care about growth. They don't care about unemployment. They are going to keep tightening until they see what they want in those backward-looking measures of inflation. And I think in doing that, the Fed is sending two very different signals to different types of investors. To bond investors, the Fed is saying, we've got your back. Go ahead and buy that 10-year Treasury at 3%. We're going to make that a money-good investment by bringing inflation down. To equity investors, he's saying, too bad, so sad. You're going to have to deal with a very likely recession and all that's going to mean for corporate earnings. So I think the market kind of read this correctly today. Bond yields, not really much action there. Equity prices, pricing in potential earnings pain.
Okay, so let's stick with equities for a second here, Michael. The mid-June lows, we had rallied pretty nicely off of those. July saw a gain on the month of 9% for the S&P. Up until today, we were basically flat on the month of August, but perhaps a different story now with the Dow shedding 1,000 points, as our screen shows. Do we retest those June lows? What's in store for stocks going forward?
Well, the challenge in trying to decide whether we're going to test those June lows is the rally off the June lows was very, very rationally motivated. We've seen money supply collapse from a positive 25% to a 4% shrinkage. We've seen commodity prices collapse. We've seen a rollover in housing inflation. We've seen a rollover in the headline inflation rates. All this is signaling that the Fed should not be so single-mindedly focused on backward-looking inflation. It should be ready to start transitioning to say, have we got enough tightening in the pipeline? The message today was, we don't feel that way. I think the equity markets and equity investors bouncing off those lows correctly anticipated that inflation is going to continue coming down. The uncertainty that we're going to have to deal with, and I'm afraid it's very difficult to predict the actions of the Fed policymakers, but will they recognize what investors have recognized, that inflation pressures are coming out of the economy relatively fast, and that these forward-looking measures of inflation are getting better and better? Will the Fed continue to ignore that and keep tightening until we're into a recession anyway? I think that's anyone's guess. For the long run, I do believe we're going to be okay buying at levels between here and those lows, because ultimately 12, 18 months out, inflation will be down, things will be looking better.
So, Michael, my question for you is, what measures are signaling to you that July was not a one-off event? We did see inflation tick a little bit lower, but still well above the Fed's 2% target. But people unsure as to whether or not, again, that was a one-off. What indicators, data points are you seeing that indicate that inflation will continue to come down here in the month of August and ahead?
So I'm an old-fashioned Friedman monetarist. And when money supply hit 25% 18 months ago, we started saying we're going to have a very nasty bout of inflation. We have now seen, because of the Fed tightening and the market reaction to that tightening, we've seen money supply collapse, and it's now shrinking. That's the number one motivation for us to be comfortable that inflation will keep coming down. You're seeing that money supply impacting commodity. Lumber is back to the lows of 2.5, 3 years ago. Oil is coming down. Copper has collapsed. These are all the forward-looking measures of inflation. And then there's one other big deflationary impulse that no one seems to be talking about, and that is, while we've been freaking out about inflation, China property markets have continued to collapse. And it is spreading beyond simply their property markets to, you saw the CEO of Huawei say yesterday that Huawei is in serious trouble. And that means, as the largest company in China, the entire Chinese economy is starting to see huge headwinds. The Chinese Communist Party isn't going to just sit back and watch the economy collapse. They're going to start subsidizing exports even more. They're going to be dumping product on international markets, and that's going to bring inflation pressures down as well.
Okay, so you said you're buying at these levels, Michael. What would you recommend buying in the stock market?
I think the two things that you buy the 10-year Treasury. I think the Fed made crystal clear today that that is going to be money good in the next 12 to 18 months. Inflation is going to come down, and that's going to be, it's good. It will also help hedge the next recommendation we have, which is growth stocks. You saw actually the NASDAQ outperform the Dow today. And I think that's a rational recognition that if we're going to tighten until we get a slowing, then that means future inflation is not going to be as bad as we feared. And so that's going to support growth stock prices. But also you're going to put a premium. If the Fed puts us in a recession, there's going to be a premium on growth. And you're going to want that growth in your portfolio in the next 12 to 18 months.
Now, are there certain stocks? Are you stock picking, Michael? Or would you recommend buying growth outright in the form of a NASDAQ ETF, for instance?
We're an asset allocation firm, so we're not focused so much on individual names. I will say that an interesting way to play our growth thing is to actually buy quality instead. There are plenty of ETFs that play a quality theme instead of a pure growth. What you get in quality is you get the same kind of growth characteristics, solid balance sheets, the kind of companies that do well in a slowing economic environment. But the quality trims off the most frothy, excessive valuation companies that tend to hold growth back. As a matter of fact, over the last 30 years, quality has outperformed growth by about 300 basis points per annum with very similar upside characteristics.
And what are some of those ETFs that you think do provide quality and growth at the same time?
Well, we are partnered with S&P. They provide the Intel Inside to our analytical process. So I probably, for compliance purposes, shouldn't. I've got a little bit of a bias there towards the S&P indices since they're our partner.
When it comes to the Fed's path forward, of course, we're going to get more data, Michael, between now and that September meeting to show what's happening with inflation, to show what's happening with the jobs market. The jobs data absolutely soared that we saw in July, more than double what economists had expected, and more than 500,000 jobs created, which during any economic time is about 3 times what you would normally see on a monthly basis. And so how does that factor into the inflation equation, into the economic outlook? If job gains continue at very strong levels, is it possible that inflation can really come down?
Well, we believe that we're kind of living through a fairly unique kind of job market. And actually, this is one of, I think, the tragedies of the Fed's backward-looking focus towards inflation, because I think this is one of the rare times when they actually could achieve a soft landing kind of Goldilocks outcome. And the reason is that for the last year and a half, 2 years, corporate America has struggled to attract enough talented individuals to staff their operations. And they are right now very cognizant that employees aren't a cost. They are an asset. So for the first time in my lifetime, corporations are seeing slowing growth, and yet they are not laying people off. They're fighting to maintain their staff. I don't think that's a symptom of inflation. I don't think that is a symptom of growth continuing to be too strong underneath the surface. I think it is a mind shift change in corporate America that after the pandemic, they are recognizing that their greatest assets is their people, and they're fighting to hang on to them.
All right, we're going to leave it there. Michael Jones, Chair and CEO at Caravel Concepts. Michael, thanks so much for coming on.